Module 8, Cashflow Risk Management and Contingency Planning. A. Definition of cash flow. Risk. Cash flow risk refers to the possibility that a business will experience fluctuations in cash inflows and outflows resulting in insufficient liquidity to meet operational, investment, or financing obligations. Operational risk, delays in receivables, inventory mismanagement, or supplier disruptions. Market risk, revenue volatility due to competition, demand fluctuations, or economic downturns. Financial risk, changes in interest rates, exchange rates, or debt covenants affecting cash availability. External risk, natural disasters, political instability, or regulatory changes impacting cash flow. Insight, even profitable companies can face liquidity crises if cash flow risks are not managed proactively. B. Importance of cash flow risk management ensures liquidity, maintains sufficient cash to meet obligations and operational needs, supports continuity, minimizes disruption in operations during unforeseen events, reduces financial stress, prevents reliance on expensive emergency financing, improves decision-making, provides confidence for strategic investments and growth initiatives, enhances stakeholder confidence, ensures creditors, investors, and employees that the business is resilient. C. Techniques for cash flow. Risk management cash flow, forecasting and monitoring, continuous tracking of inflows and outflows to identify potential shortfalls, integration with scenario and sensitivity analyses to anticipate volatility, diversification of revenue sources, reduces dependency on a single client, market, or product line to stabilize cash inflows. Working capital optimization, accelerate receivables collection, manage inventory efficiently, and negotiate favorable supplier terms. Use of financial instruments, hedging interest rate risk, foreign exchange risk, and commodity price volatility. Utilizing credit facilities, overdrafts, or revolving lines of credit as liquidity buffers. Contingency planning. Establish emergency funds or reserves. Develop action plans for different risk scenarios, e.g., delayed receivables, sudden drop in sales. D. Contingency planning framework identify critical risks, list events or circumstances that could create cash flow shortages, assess impact and probability, evaluate severity and likelihood to prioritize risks, develop response strategies, preventive, avoid or reduce risk occurrence, corrective, reduce the impact if risk occurs, adaptive, adjust operations to mitigate cash flow disruption, establish liquidity reserves, maintain cash, liquid assets, or short-term financing arrangements, test and review plans, regularly simulate scenarios to ensure preparedness and effectiveness. Example, a seasonal business may maintain a reserve fund during peak months to cover lean periods or delayed customer payments. E. Integration with strategic cash flow. Management risk management is not isolated. It must align with forecasting, analysis, and financing strategies. By linking risk assessment to CCC optimization, cash flow forecasting, and financing decisions, businesses can maintain resilience and flexibility. Organizations that actively manage cash flow risks can capitalize on opportunities without jeopardizing liquidity. F. Challenges in cash flow risk management, inaccurate risk assessment due to insufficient data or analysis, over-reliance on past trends, ignoring market volatility or structural changes, limited access to financing tools for emergency liquidity, poor integration between operational, financial, and strategic planning, complacency during profitable periods, leading to unpreparedness in downturns. Module Insight. Proactive, systematic, and integrated risk management is essential to sustain operational efficiency and liquidity. General, practical applications. Liquidity planning. Ensure immediate availability of cash during emergencies. Crisis management. Rapid response to delayed receivables, supplier disruptions, or unexpected expenses. Strategic growth. Safely pursue investments or expansion with contingency measures in place. Stakeholder assurance. Demonstrate preparedness to investors, creditors, and regulators. Operational resilience. Minimize disruptions in production, sales, and service delivery.